share my screen with the
Oh,
slides in that?
please do. Yeah, please do.
Yep. Now, I don't know if I don't know if other people have this problem, but whenever I go to screen share, my laptop's in, I guess it's complaining about how much work it's had to do in the last few months. It's really slow to convert across to the screen share. So, well, the full screen. So I'm doing it, but it's being a bit slow. Okay.
There's a few.
Sorry, it'll
It is.
usually just takes 15 or 20 seconds. Okay, brilliant.
The wonders of modern science.
Oh, seminar's over. Okay. No, thanks very much. Yeah, Michael and Alison, I think, was involved in the initial invitation. Yeah, it's really nice to get to give a seminar in the department. I guess whenever I get to give talk in Western Australia, it always takes me back to the first time I came to Western Australia to give any sort of talk, which was at the PhD workshop in 1989, which I guess Ken had invited me to, which I then was lucky enough to get invited along to quite a few more, and still go along every now and then. And yeah, it's a great memory to have of being in Western Australia, and obviously a wonderful legacy that Ken's created for the economics profession in Australia. So this talk, I just put my name on the cover page because it's me giving the talk, but it's joint work with Andrew Charlton. So I guess, myself through the kind of labour market snapshot series that I publish, and Andrew through the work he's doing, does obviously as the principal of Alpha Beta, but been doing kind of work independently to chart what's been happening to the Australian labour market with the impact of COVID-19. And yeah, we've sort of met up and talked a few times, and this paper kind of came about the invitation for Ross Williams to prepare an overview for the Australian Economic Review. And so I asked Andrew if he'd be happy to partner with me, which he was, which is great, because the product you're going to see really sort of is the joint product of both our thinking and the different sort of data sources we can bring to bear, which I think makes sort of what we're able to say more comprehensive. Okay, so I'm going to start off with sort of three graphs, which I kind of think tell the story of the COVID-19 recession. If you read the paper, you know at the start that I sort of say, you might wonder why would you want to have an overview of this recession sort of after 3 months? And I think the reason is that, as much has happened in these 3 months as we might usually have happened in a decade of the labour market. And so it seemed useful to us to put together an overview. And I guess the other thing we say in the introduction, it sort of seems like it's the recession of the big graphs and that. What's happened has been so striking that through graphs you can really tell sort of the story quite powerfully of what's been happening. So here's the first graph. This shows changes in monthly hours worked since the start of recessions in the early 90s, the early 1990s, and now. And you can see that the standard recession in Australia is one where basically monthly hours worked decline gradually over about an 18-month period, then enter sort of a trough for about sort of 6 to 9 months. That trough is about 6% decrease in monthly hours of work. What we've had in the COVID-19 recession is in the first month, we lost about 9.5% of hours of work, then about another almost 1% the next month, and then a reversal of 3.8% May to June. The decrease from March to April, and then the increase from May to June, they're the biggest decrease and increase as far back as we can go to the 1970s in 1 month changes in hours of work. If you're wondering why I'm using hours of work rather than other measures, sort of, as you'll know, the problem with JobKeeper is that it's really kind of messed with the way we can interpret employment numbers, because
Sure.
you've got a whole, because the ABS definition of employment includes people working 0 hours if they're being paid. And at least in the initial months of this downturn, this recession, there was a lot of people working 0 hours who we don't know for sure, but we think that a lot of them were on JobKeeper. And so, you can look at employment, you can look at unemployment, but my feeling is that the best representation at the moment, and probably for, as long as we've got JobKeeper around of labour demand, is to look at monthly hours worked. And so this is basically telling us we've never seen, a decrease in labour demand of the severity and speed as we've seen in this episode so far. I mean, the reversal is also interesting. I'll come to that sort of when I start trying to talk about why or understand this pattern. The second graph is the long-run history of the rate of unemployment. So while I think it is really difficult sort of at the moment to kind of directly compare the rate of unemployment, it's sort of useful to do it because it's the one measure we've got back a long time in history. The ABS, who I think have been fantastic during this period with the extra data they've been reporting. I think very lucky to have sort of economist David Gruen there for this episode, who's been incredibly proactive in generating new data and helping people to interpret sort of what the numbers mean. ABS has calculated an adjusted rate of unemployment where they try and add back in people who they think are on JobKeeper. And when they do that, they get an unemployment rate of about 10%. If you chart back sort of to the start of the 20th century, you get a brief period in the 1990s recession when unemployment was above that. And of course, you get the Great Depression. Those are the only periods when unemployment's kind of been around the level that we're at. So yeah, there's no doubt that we're talking about, a downturn or a recession that's also, extremely severe on a historical scale. I guess what remains to be seen, for example, compared to the Great Depression, is the duration. The third introductory graph I've got is a graph that shows it's an index for the number of jobs. And there's a blue line, which is the ABS ATO series, where they've taken the single touch payroll data to create the series. And then there's the Xero data, so Andrew's firm Alpha Beta have a partnership with Xero to basically take the Xero data. So Xero, you might know, is this tax software company. Small and medium businesses use it a lot to put their accounting information into, and they can then directly upload from Xero to the ATO system. It's a system that's used mainly by sort of smaller and medium businesses. You can see from these series that they both show sort of large decreases in employment before the announcement of JobKeeper. The Xero data goes further down, probably showing that there's been a larger negative impact on small business than on average for businesses. Then you can also see in the ABS ATO data kind of a recovery in employment through to late or number of jobs. Of course, not exactly the same thing as employment because people can have multiple jobs. A recovery through to the 27th of June date, and then sort of a decrease, or late June, then a bit of a decrease after that. A couple of reasons for sort of including this chart. One is that it's sort of it's more up-to-date information about what's happening in the labour market, in that the latest labour force survey data we have is up until the middle of June. That showed recovery from May to June, but we don't really know what's happened since then. If these jobs data are a reasonable reflection, then it'll probably show that it's fairly flat, because for a couple of months in June, jobs kept increasing, but then they've come back down.
Jeff, just on that though, Victoria's had a big shutdown, right? So it's right around you.
Yeah, exactly. I'm going to show you some data on that later on, Rod. So this isn't Australian. Well, this is Australian data, but clearly there are compositional effects, sort of, which I'll come to, sort of. So, which is obviously important for understanding kind of what's driving the decrease in that.
Right. Okay.
So two other reasons I include this graph. One is that this recession, I think in terms of being able to study it, is very special with real-time data. Like, previously we would have been just waiting for the ABS to come out with the labour force survey, which would have been about probably 4 or 5 weeks behind. But the ABS have been incredibly proactive with producing the single touch payroll data series. That means that we're only sort of 2 to 3 weeks behind. And of course, you've had Alpha Beta partnering with Xero to create sort of the real-time Ilion data on consumer spending and the data on the number of jobs. The other reason I put this graph in is just as kind of a taster for sort of the idea that, look, policy has been incredibly important in this recession sort of, and so you kind of notice that around the time that JobKeeper is introduced, that's when jobs start declining, or when the rate of decline in jobs starts to slow. Like, I don't want to argue there's anything causal at the moment. It's real. We'll come to that later on. But I just want to say, look, this is a way of pointing out that introducing the idea that policy has obviously been hugely important. Okay, what I want to do now is kind of talk about what I think the 2 main drivers, and perhaps what will become a 3rd main driver of this downturn have been. And I think keeping always in your mind what the drivers are is incredibly important sort of for understanding what's going on. I think that for 2 reasons. One is, like, as we know, once you understand sort of what's driving things, that lets you understand it. But I think the reason why it's really important to be precise about it in this episode is that the drivers are obviously different sort of. Like, you see some commentary about, well, even really early on in this downturn, well, look, if you have a recession, then it means that, it takes 2 years for unemployment to increase, 4 years for it to come down again, and that. And you're trying to use history as a guide. And I think at least in the initial stages, we can't use history as a guide to the same extent as we might have, say, in the 1990s, drawing on the experience of the 1980s or the 1970s. But you've really got to think about this recession, in its own terms. And so obviously that means, starting with the impact of COVID-19 on, initially household spending. We know that COVID-19 is spread by personal contact. And what that's meant is that there's been a decrease in spending on economic activities involving personal contact. Accommodation, food services, arts and recreation services, indirectly on some activities where the government was worried that it would facilitate the spread, like international aviation and so on. One of the interesting things, and a lot of really interesting research coming out of the US on this at the moment, is the extent to which that decrease in spending has come about voluntarily or because of government restrictions. And obviously sort of there's no one right answer to that for every country. I suspect that the relative influence of those factors probably depends on the timing of the restrictions relative to the disease. But in the US, where the restrictions were probably imposed relatively late in the progress of the COVID-19 in many states, there's a series of papers which are using sort of different types of data, spending data like the Ilion data that we have, that Alpha Beta is using in Australia, but also data on foot traffic in retail areas, data on sort of restaurant bookings and that, to show that basically in the US, the largest fraction of decreases in spending seems to have come from high-income households voluntarily withdrawing from consumption activities associated with a high level of personal contact. And so they've got really good data sort of that, where they're able to kind of identify which households reduce spending, and link that up with geographic data on business revenue and that, and to show that there's a really strong story about voluntary withdrawal. Which obviously kind of goes to points as well about how much bounce back do you get when you remove government restrictions, that's probably going to depend on the progress of the COVID-19. Now, because not all industries obviously involve personal contact. I mean, when I say personal contact, of course, what I mean is contact, within work, among workers, among customers, and between workers and customers, sort of all those dimensions. And those dimensions obviously vary by industry. So what we've seen as well, as I'll show in a minute, is a very concentrated impact by industry. So in the initial sort of phase of the COVID-19 recession, the big driver has been the impact of COVID on household spending. To jump ahead a bit, obviously that's why we saw the big decrease in hours worked in from March to May. But then that's why we saw a pretty quick bounce back, a third of the hours made up again from May to June, because we thought we had COVID under control and some of the restrictions were starting to be removed. But it's only by understanding that this is the driver that I think you can really understand kind of the timing of the changes in employment and the pattern by industry that we'll see. I mean, obviously then what I think of as the second main driver is government fiscal policies. Ian McDonald tells me, no, there's just one main driver, it's COVID-19. And yeah, I kind of see his point in that if it wasn't for COVID-19, we wouldn't need government fiscal policy. But I think it's kind of useful to at least tease things out a little bit more, sort of to think about the drivers. So I think we can think of government fiscal policy sort of as being, a major sort of independent driver. We've had JobKeeper, the superannuation withdrawal, for example. And I think it's really important to understand how substantial that fiscal stimulus has been. So this is a graph that Alpha Beta have put together and that I've worked on a little bit with Andrew on a couple of the elements in it. This is basically their attempt to model household cash flow in April to June 2020. And what they're saying is, look, basically COVID probably cost about $14 billion of wages and about $3 billion of unincorporated business income. That's the brown bars. The blue bars are the various types of stimulus. So the 4.9, that's the $750 payments to benefit recipients. The 7.4 billion, that is job seeker, and the fact that the $550 payment, which is made to job seeker recipients, also went to selected other categories of benefit recipients like youth allowance and so on. 6.6 billion is JobKeeper. 19 billion is withdrawal from superannuation accounts, and 3 billion is withdrawal from is mortgage deferrals, the value of mortgage deferrals. So what this tells you is that in fact government stimulus added $22.3 billion to cash flow, even once you take account of the negative impact. So the impact of fiscal stimulus on cash flow, not necessarily spending, but on cash flow, has been massive. And the other thing that just like I couldn't believe these numbers, because I'm so used to thinking JobKeeper is the big thing. JobKeeper is the big thing because of course I'm the labour economist, so you've got to think that the labour policy is the big thing. But that's been only a third as important as people withdrawing money from their superannuation accounts in terms of the impact on cash flow. And it gives you a sense of sort of like the long term. I mean, essentially, kind of government has cost shifted the fiscal stimulus sort of to the future by getting people to draw down on their superannuation balances in this way. That a large part of the fiscal stimulus is sort of cost shifting to the future. But never. So anyway, this is cash flow. You might say, well, that's kind of interesting, but there's all these restrictions. Are we actually seeing people spend the money? And so this is some analysis that Andrew and others at Alpha Beta have done, where they've uses the Ilion data, where they were able to identify households who received either or both of the $750 initial supplement payment at the end of March, or the $500 or the $550 benefit payment, addition to benefits during this time. And they then match that against sort of, households with sort of, similar characteristics and profiles to do a comparison, who weren't getting stimulus, to do a comparison. And basically you see that, up until sort of late March, both those types of households had experienced quite large decreases in spending, about 20%. Then the group who get the stimulus, sort of when that's announced, they jump up a lot, come back down a bit. But then sort of once the $550 cuts in, their spending increases again. And basically they've been pretty consistently sort of spending, 30–40% more than the households who didn't receive the stimulus. So this isn't kind of exact in terms of amounts and everything. It's more suggestive of the fact that, at least some of the spending, some of the benefit payments are flowing into increased spending. It remains for further work, obviously, to really sort of look at that in a lot more detail.
How does the total look in this picture? If you add in those who did and those who didn't get it, how's the total going to look? Negative or positive relative to the 100 base?
From memory, it is down a little bit, but not down hugely. Like the proportion of the population who are getting these payments, I mean, it's large. I can't remember exactly. Maybe it's something like 20% or something like that, because the payments were pretty broad. They were to job seeker, age pension, youth allowance, and so on. And I think when you kind of add together sort of, about 4/5 going down 20%, but then the 1/5 sort of up about 30 or 40%. I think from memory it's down, but kind of like it rocks along about sort of 4 or 5% below from back in kind of late April.
That should be the money line in this diagram, if we're interested in what's happening to the macro economy.
Sorry, could you say that again?
That should be a takeaway point from this graph. If we're interested in what happens to the macro economy or the aggregate labour market, what happens in the total?
Yeah, I guess, the point of this graph was to kind of illustrate that some of the stimulus is being spent. But that's a good point, Ken, that if we added in a total line, then it would kind of reinforce the point about some of this spending actually underpinning a decent level of aggregate spending. So thanks, that's a good point.
Jeff, and I'm probably just pointing out the obvious because it's just on your last slide, but obviously the people who are able to withdraw down their super are a select group, and it's also the same people that have been getting those, extra COVID payments. So presumably that's why it's not just the stimulus payment that's been spent there, but it is, as you pointed out, the super money as well.
Exactly. They've done similar stuff, sort of identifying the effect of, you may have seen it in the papers and that, looking at people who they know got the 10,000. My understanding is that this is supposed to control for the 10,000 sort of, that the samples are matched to control for that. So that it just focuses on individual level spending, because otherwise, Alison, you'd be exactly right that there's obviously going to be correlation between those, and so that's why you kind of wanted to do it sort of match that, because when you've got so many different packages and payments going on, you could be confounding things together sort of. So that's a good point as well.
No, could I ask one other quick one?
Sure.
Just the orange line, what do you know what proportion of those represented in that orange line actually lost employment or lost hours? You probably don't have those data, I guess.
No, the problem is that, well, you might be able to make inferences on it, but it's hard because of JobKeeper, because, so this is, in in the appendix to the paper, describe about these data sources, but yeah, it's probably, I've said about the zero data, I should say about the Ilion data. Basically, Ilion's a credit rating agency. And so you may or may know this, may or may not know this, but if you've ever agreed to have a credit check by Ilion, you're signing over your right for them to sell basically your all of your bank information to third parties and that, de-identified of course, to use it for sort of research purposes. And so this is a sample of households, basically have had credit rating checks, the history of sort of what's been happening to their bank balances, well, not their bank balances, but basically everything on their bank accounts during this time. And so you can identify sort of like getting payments in, the 750 and the 550 on the dates when that would have happened. That's pretty easy to identify because we know those dates exactly compared to it not happening. And then you can sort of, you can do aggregate spending sort of as well. But we don't know. There's no direct employment indicator there. You might be able to guess at it if someone was earning like $2,000. If they were getting this regular $2,000 amount every fortnight, and then all of a sudden that disappears. But of course, there could have been people, who were working less, and then that goes up to the $1,500 for JobKeeper, or goes down. So it's a bit messy to think about employment sort of.
Yeah, I mean the reason I mention it is that your earlier hypothesis that a lot of the decline in spending is relatively wealthy people whose jobs are probably maintained online like ours, who are in fact just not going to coffee shops anymore. Right?
Yep.
So, and it would be very interesting to know what proportion of the drop in spending is due to that, and what proportion is actually due to the unemployment.
Yeah,
job
that's
displacement.
Okay, yeah, that's. I don't think what we can do, and what we do talk about there's a paragraph in the paper where we talk about this. We have done the stuff at looking at spending by income, and yeah, it's all like basically lower income households have pretty much just, kept their spending the same, but the high income households have reduced a lot, and they've reduced it on these personal contact activities. So we're seeing the same kind of outcomes as in the US. But yeah, what it's more problematic to say is the extent to which we could probably get at it roughly, I guess, by doing measures of the proportion of the income being received by those lower income households that's made up of these payments, and how that changed over time. So yeah, it's a good point, Rod, to try and relate this, not just look at income, but try and relate it more directly to making up for job loss as well. No, thanks. That's a good.
Yeah,
You can't do it exactly.
Sort of, it goes to one other thing that's probably a bit peripheral, but we have this weird situation where stock markets are rising, and other measures of economic health suggest serious recession.
Yep.
And if what we're observing is very wealthy people actually spending less, saving more, then that could be driving the asset price rises.
Yep. No, I've certainly seen that mentioned as one hypothesis for what's going on.
Thanks.
In fact, I think in the US, like, it's absolutely amazing. You look at the NBR working papers, I guess others we've done the same. Just the flood of research sort of on this topic coming from there. And I'm pretty sure in the last lot that I actually saw a paper on the impact of extra high income savings on the stock market in the US sort of. So I suspect there's something in that in Australia as well.
Yeah. Yep.
No, thanks. That's thanks for all those comments. That's really helpful. Then the third potential driver, I think it's an open question, the extent to which this has already happened, is whether the initial impact of COVID-19 causes a longer term and broader based decline in aggregate demand. That is, we morph, even if we get COVID under control and are able to substantially reopen the domestic economy, obviously international borders is a bit more problematic, we still could have a sustained downturn, a sustained recession, because that COVID's, for example, it's reduced people's incomes, it's reduced business profitability, it's made people less confident and uncertain. You know, Melbourne University, for example, you know, they immediately delayed $300 million of construction spending when this happened, sort of. So, yeah, that's an example of the kind of spillover effects out of a directly affected sector, higher education, to other sectors, sort of. And, you know, and I guess the point is that, you know, if that's, and obviously it's related to the severity and the duration of the impact, direct impact of COVID, but that if that ends up being sort of substantial enough, then we'll end up with a usual type, you know, the usual type of recession. So I guess my point is, I think it's really important to keep these three drivers in mind as distinct drivers of what's happening, and probably also over time to kind of be adjusting the relative influence of each of them. So at the moment, I guess obviously you put most weight on 1 and 2, but at some point in time, we may think that COVID isn't really directly influencing or it's not the main driver of what's happening so much anymore. It's more moved to, you know, 3 and 2 and that. Okay, so what I want to do now is basically say about what's been happening in the labour market, start off with some aggregate data and then kind of drill down a bit. So this kind of just gives you some more information that was, you know, a broader perspective than was in the very first graph. So March to April, we see the really massive changes. You know, a couple of interesting things there, that the decrease in employment is so much less than the decrease in hours worked. Usually in recessions, what we find is that basically most of the adjustment in hours worked comes via employment. But in this case, of course, we had JobKeeper, meaning that you had a whole lot of workers who who were working 0 hours and usually would have counted as a loss in employment, still being counted as employed and accounting for that sort of difference. The other interesting thing is how close the decrease in the labour force participation rate is to the employment population rate. Usually sort of the flow out of employment in a downturn is about 3/4 to unemployment, 1/4 to out of the labour force. But I guess, you know, probably mainly because of the you know, the severity, the discouraged job seeker effects have probably just been huge during this period. People who are out of employment just likely to move out of the labour force altogether. April to May was kind of, I guess, you know, this is when the restrictions were all in place. COVID was sort of on its way to appearing to recede, but you know, not, I guess, at the stage of making too many relaxation of restrictions. So you can see that things were kind of in a bit of a holding pattern in a way. A small extra decrease in monthly hours. Employment falls away a bit more. I think what happened there was that there was some workers who were on 0 hours back in April who weren't being paid by JobKeeper but thought they might be called back to their jobs. And when it became clear they weren't, they kind of flowed into being out of employment. That led to more decrease in employment population rate and the labour force participation rate. One other thing just to point out, I guess, is that that when you have sort of so much of the flow out of employment going to out of the labour force, it again affects the interpretation of the rate of unemployment. So you will have heard, I guess, lots of different rates of unemployment floating around. I guess, you know, ScoMo and Joshy disagreed with themselves on the same day about whether it was 13% or 11% sort of. And I think, you know, it's because people are using all these different measures. You've got what we usually regard as the unemployment rate, the ABS official rate. Then the ABS is reporting the rate which includes what they think of the workers on JobKeeper. But then I guess, you know, some people are also calculating a rate of unemployment that includes the people who moved out of the labour force since March as unemployed as well. Doing that, I think, actually sort of overestimates the rate of unemployment, what a historically kind of constant rate of unemployment would be, because some people do always move out of the labour force. But yeah, this was the period when, if you did add on those two other groups, the rate of unemployment was up around 13%. Then May to June, we had a bit of a bounce back. So monthly hours made up a third of what they'd lost from March to May. Employment increased a bit. Labour force participation rate increased more than the employment population rate. So sort of unwinding of the discouraged worker effects a bit. I guess I've sort of made this, but two of the kind of interesting things about the pattern of adjustment early on is that usually in really severe recessions, most of the adjustment in hours worked is via decrease in employed persons. But because of JobKeeper, you kind of saw a big change in average hours worked as well. But as the economy's recovered, the proportion of the decrease in hours worked accounted for by employed persons has been increasing. And then there's this other issue of how the distribution of the decrease in employed persons goes to unemployment or out of the labour force. And usually that's about 3/4 a quarter, but in the initial stages of this recession, it's been much more to out of the labour force, I assume because of discouraged worker effects. Some people say it's because of, they'll say, oh, it's because they took away mutual obligation requirements. And that means that people who would have been classified as unemployed because they were job searching are now out of the labour force because they're not searching. But when you look at the flows data, if that was the case, you would kind of expect to have seen quite big flows from unemployment to out of the labour force, because it's not just people who become unemployed now who have had the mutual obligation initiative removed. It's everyone who's unemployed, and you don't see very much flow. Most of the increase in out of the labour force is just people going directly from employment. So I'm not convinced that the removal of mutual obligation initiative sort of has had that much impact on how people are being classified in the ABS data.
Jeff,
Okay.
would you
Who's
have
being
any,
affected?
sorry, Jeff, just quickly,
Yep,
would you have any note on your mutual obligation, a sort of related one, the whole childcare effects? Would you be able to sort of, comment how that has or has not affected, these labour market aggregates as well, or have you just not got that data?
Yeah, I think it's so definitely, Alison, when you look at these numbers, and yeah, I guess I've focused on the discouraged worker effect, but actually in the paper we do say that the other reason why the labour force participation rate's likely to have decreased by as much as it did in this downturn. So yeah, thanks for bringing this up, because it's an important point as well, which we talk about. It's probably to do with the nature of the downturn as well, with schools being closed, and and we know from the ABS household data, females especially having to take on sort of extra child caring duties in the home, and homeschooling and so on. So it's impossible to say how much of this is discouraged worker effect and how much of it's the female withdrawal for caring. But it's an important point. So yeah, I should have mentioned that. Thanks for raising it. Yeah, the one way you probably could get it at it, Alison, I think, is the ABS now has the kind of longitudinal version of the labour force survey, and I guess you could roughly get at it, for example, by looking at who it is who's withdrawn, and looking at their family circumstances. So that would be one way to get at that. So, who's been affected? Well, I'm going to start off with the industry, and I'm doing that for a really big reason, because I said, look, you've got to think in terms of the drivers, and the big driver is COVID, and COVID's had this concentrated industry impact. I think once you understand industry, you understand a lot of what else has been happening in the labour market in the first 3 months of COVID. So, yeah, when you look at this, you see, as you'll be familiar with, I'm sure, in percentage terms, big decreases in arts and recreation, accommodation and food services, decent sized decreases in other services where there's also a lot of personal contact, transport, postal and warehousing. So that's mainly transport, aviation, but also, taxis and other types of transport. So yeah, basically very concentrated sort of on the industries where there's personal contact. And then that's made up a lot of the total decrease in hours worked as well. So the decrease from February to May in accommodation and food services makes up a quarter of the loss in total hours. And then, retail is about 10%, arts and recreation about 8%, other services about 9%, accommodation, transport. So yeah, you can get to sort of pretty easily to sort of about 2/3 of this decrease in hours work being concentrated in industries where there's a high level of personal contact. So I guess my argument is that the industry pattern has very much reflected the impact of COVID-19. And that's clear as well when you look at sort of, basically the ABS data, we only have the latest industry data in May. So that's a period when employment was just decreasing. But if we go to the payroll data, we can look at what's happened after that. And you can see basically, exactly in line with this idea that COVID and personal contact are driving the employment outcomes, you get these really large bounce back in accommodation and food services. I didn't put it in this graph, but it's the same in arts and recreation services. So yeah, really just as the decrease was concentrated, so the increase has been concentrated as well. Obviously not coming back to where it was in March, but making the point that, look, the big thing driving the evolution of employment has been COVID, and the impact of COVID has varied strongly by industry. Now, what we do in the paper then is kind of some just simple exercises of saying, well, okay, we know that there's a particular occupational composition within each of these industries. We know there's a particular gender composition. We know there's a particular age composition. Suppose that we just, suppose what we do is, for example, we predict what would have happened to the gender composition of employment just based on these industry level changes in employment. So, for example, if in accommodation and food services, it's 50% female, 50% male, well, suppose 50 females, 50 males, and employment in accommodation and food services, decreases by 40%. Then we say, okay, the impact of that is that in May there's 30 males employed and 30 females employed. That we've basically wiped out 20% of the male employment, 20% of the female employment. And then we do that sort of across all the industries. And we kind of say, well, what does that imply about the change in, for example, male employment and female employment, and employment by occupation and employment by age. And if you look in the appendix of the paper, appendix tables 2A to 2C, you'll see that you don't get it perfectly right, but you get amazingly close to what actually happened to employment by occupation, employment by gender, and employment by age. In other words, our argument is that, yes, there have been big changes in employment by gender, occupation, and age, but for the most part, that's been driven by the changes in employment, given that those industries have quite different gender, occupational, and age compositions of employment.
Yeah, quick question, if I can, just on the graph you have there. If you take retail trade, for example, does this retail trade include online retail or not?
Yeah. So this would include online retail as well as I mean, it won't include kind of the parcel delivery part of that. That'll be in transport and that, but it'll include the it'll include the Amazon jobs in Australia and stuff like that would be included.
Yeah, because it seems to me that that has major compositional issues, doesn't it? I mean, there's been a transformation from face-to-face retail, which would be more female, to online retail, which I presume, from from what I understand about warehousing and so on, it's mainly male. Right?
Yep.
So,
No, that's a really good point in a couple of respects, Rod. So yeah, the general point you're making is that this industry classification, like one digit, it's quite, like, I think it is really useful to work at that level because it is so powerful. But as you're saying, Rod, that's not describing all the action that's going on.
sure.
That there's also been substantial sort of reallocation of employment within some of these industry categories, sort of. And that I think that has a that is an important point, sort of in and of itself, sort of that. If you want to understand what's happening to the structure of the economy, it's not just that we had this decrease. In some ways, it's in the long run, it's the bigger story, sort of, probably, because while we may believe that retail spending will bounce back eventually, that accommodation and food services sort of might bounce back or whatever, that there are going to be compositional changes within those industries that may be more permanent. So, for example, within retail, a shift towards sort of the large kind of mega online suppliers versus the smaller bricks and mortar stores. And so in the long run, it's quite likely that's a bigger story, sort of, than this, what at the moment is the biggest story, these huge shifts by industry. Sure. But yeah, it's also a really good point in the context of, like, me saying that, well, look, if you just kind of use the one digit industry percentage changes in employment to forecast what happens to employment by gender, say, you can get pretty close, but of course you don't get there exactly. And so there's other factors which are driving that. One of them is as you're saying, there could be these compositional changes within these industries, sort of, which, for example, favour male, more sub-industry categories where there's where employment's more male intensive, and so on, sort of. There's also other factors, I think, or one other major factor which we'll come to when we talk about employment by gender. But no, that's a really important point to raise, because I think, I think it makes sense in the short run to focus on the one-digit stuff because it's the main action. But in the long run, I think that reallocation story within industries is incredibly important.
If I could just make a point too,
Sure.
Jeff, I think it's quite interesting to look at the healthcare market. I mean, we're seeing a reduction in employment now as worked there also, which is somewhat counterintuitive. So it might suggest that maybe people were delaying treatment or etc. Do you have any thoughts on that?
Yeah, exactly. You can see that. You can see that when you go more disaggregated in the industry data. That because when this started, sort of like before we actually had any data, and we thought COVID could get really bad. This is, what were the sectors we were predicting would be booming? It was like working in supermarkets, it was cleaning services, and it was healthcare. But then what's happened is that because, at least initially, sort of, well, and everywhere else in Australia except Victoria at the moment, we got COVID under control. That meant that there wasn't the big increase in employment, but instead it's dominated by, basically decreases in elective sort of hospital procedures, dental stuff as well, sort of. So no, exactly, Michael. And so that's another good example of kind of needing to understand the real story underneath some of these things. You need to kind of look at the more deep, the 2 or 3 digit, 4 digit data, sort of. So exactly.
Just Jeff, a quick question, Jeff, if I may. So talking about compositional effects, just to understand, do you have any understanding on how the unemployment effects were on, say, part-time workers versus full-time workers in these respective industries? Because I think that will have important consequences on how the recovery happens, and also on the third point that you mentioned on the long-term effects. Because if you assume that full-time workers are the ones that are being affected, then that will have productivity effects in the long term as well.
Yeah. I mean, I guess so I agree with what you're saying, that my view on that would be that at some point it will become really important to start looking at who is unemployed, and what skills they have and what industries and occupations they've come from. But I guess my feeling's been that while the labour market is still in such a state of flux, that we could look at people who've become unemployed, say in May. The problem is that's not a complete depiction of people who really, are working a lot less hours than they used to, or maybe even working 0 hours. And, once we relax the restrictions, a lot of them are going to move back into employment, or once COVID sort of recedes. So I agree with you that at some point it will be really important to start looking at the pool of unemployed and understand their backgrounds. I think at the moment sort of that to do that would be kind of, obviously I'm not saying we don't need to worry about we've got this increase in unemployment sort of, and the implications of that. I think at the moment the big way to deal with that is through it's kind of generalised policy, but at some point it will become really important to worry about, who are the unemployed, what are their skills and background in terms of assisting them back into work. But to me, that's probably kind of, once we get them, that's a job for, there's some things we know, like as I'm about to show, and as I'm sure you know already, we can predict that there's likely to be a big impact on the young sort of, and so we can start to think about policies for them now. But in terms of people who are becoming unemployed because of these industries, I think it's sensible to sort of wait till the numbers settle sort of a little bit. Okay, so now I'm just going to talk about by type of job. This is pretty striking, I think. Basically, what I've done to get to this graph is that I ordered all of the occupations from lowest earning to highest earning based on weekly earnings. And then I've waited for their initial employment size in February. And then I've looked at the percentage decrease in weekly hours work. So essentially the first decile, that's the 10% of workers, that's the 10% of workers who at February 2020 were in the occupations that were kind of that were the lowest paid. So it's you kind of ordering the occupations and you cut off at the point where you get to 10% of total total employment.
Jeff, can I just butt in? Can you just clarify what digit levels you're using here? Would that be 3 or?
For this I used 2 digits. So there's about, this is based on, I think like 55 occupation categories. Yeah, that's because that's what I had could get the earnings data for sort of. So anyway, this is it's ordered by weekly earnings, and basically in each of the deciles there was an equal number of workers in February 2020. And what this shows is obviously you've had much bigger decreases in employment for workers in lower paid occupations. In fact, the bottom 3 deciles account for about 60% of the total hours lost between February and May. And this isn't kind of some full-time, part-time thing either, because what we're doing it is in terms of the total weekly hours sort of and that. And each of the groups is the same in terms of weekly hours to start off with sort of. So it weights full-time and part-time kind of in terms of their hours. Okay, casual and permanent. So this comes from the alpha beta 0 data. You can see casual, we've got permanent part-time, permanent full-time. They're all kind of rocking along the same until the middle of March, when suddenly COVID hits and basically employment of casual workers decreases by about 25%, whereas for permanent workers it really hasn't changed very much at all. So big impact on casual workers. Even before JobKeeper was announced, which of course excluded casuals who'd been with their employer for less than a year. So I think there's an important message here, which is that it really kind of has exposed the precarity of casual employment. Like, I guess I've been saying to people, look, for the last 5 or 6 years, there's been this argument about has casual employment increased by 2% or decreased by 2%, and it turns out that when you have an episode like this, the big issue is that casual employment is 25 to 30%. So there's a substantial group in the workforce who are, you know, significantly exposed to sort of, you know, job insecurity when you have an episode like this. Okay, by worker type, so gender. So what I've got here is monthly hours, employment population, labour force participation rate of unemployment. So the story from March to May sort of is, well, the overall story I think is well known, but the initial story is well known as well, that females experience bigger decreases in hours worked than males, bigger decrease in employment population rate, bigger withdrawal from the labour force. Now, I think probably, you know, there's several things sort of going on there potentially, which it's difficult to kind of tease them all out, but part of it is the industry composition of employment. Basically, as I said, you know, if you just predict what the impact on males and females would have been based on the industries that are affected, because those industries, the mainly affected industries, happen to be industries that affect that employ relatively even proportions of males and females, you get the result that that there's a pretty even impact. But obviously, sort of there's been a larger impact on females initially. If you go back March to April, the gap is even bigger. Like in May, the gap's 2.3%. Back in April, it was about 4 percentage points. And so I think there's other stuff going on there. Rod's mentioned that it could be within industries, composition of employment stuff. I think, as Alison mentioned as well, some of this decrease in employment may be to do with females with having to withdraw for, you know, to provide the bulk of caring roles when their children are home from school, because we know from the ABS household survey that females are doing a disproportionate share of that work. The other thing in the data initially was that there was a much bigger share of females, sorry, a much bigger increase in females working classified as sort of employed and working 0 hours than there were males. So that's not going to show up in the employment population rate because they're classified as employed, but it is going to show up in the hours worked. And I think sort of there's probably a fourth factor is that at least in the initial stages, there was a greater propensity for employers within those industries where, even though there might have been equal proportions of males and females, to adjust downward the wages of females to adjust downward the employment of females than males. At least I think, you know, when you look at that 0 hours data, you have to take seriously that idea that that's kind of on the margin one of the reasons why females have lost more hours than males.
Jeff, surely
Yep.
it's also just the fact that proportionately most casuals are women. And so there, from a contract basis, it's easier to get rid of your casuals or to reduce the hours of casuals than it is any other.
Yeah. No, that would feed into the kind of the, if they're long-term casuals, you know, then that would feed into the 0 hours point, sort of, that because more females are casuals, they're more likely to be laid off, but then, you know, they can be receiving JobKeeper sort of on and working 0. Yeah, that's why they're classifying themselves as employed and working 0 hours, because they're on JobKeeper. But yeah, because they're casuals, they're more likely, as we saw in that graph before, to have had their hours decrease. So no, I agree with that. I think that's, yeah, that it's a step further in kind of the, it's the underpinnings of what I was saying about 0 hours sort of. So yep, exactly. From May to June, you actually saw sort of stronger recovery in female employment than male employment. And again, I think this has really kind of been mainly driven by, you know, the COVID impact, you know, affecting, you know, the industry sort of impact of COVID, and maybe also the undoing of, you know, some of the, you know, household, you know, care impact on females as well, with COVID receding. So, you know, by if you take the whole of the period from March to June, female hours are down 7.3, male hours are down 6.5. So still sort of greater, but sort of converging, you know, with the undoing of the COVID impact. of course, yeah, I mean, I think this obviously, as we talk about in the paper, doesn't tell the whole story sort of by gender, like, the fact that, there's females who are still employed, and have been working from home, but have been having to do the, potentially bulk of homeschooling, especially where that's, single, female sole parents and that. I guess there's obviously a real concern that, that could translate into, career progression, opportunities, and that sort of coming out of this episode. So I think there's a variety of aspects of labour market, gender-related policy, which kind of is going to be important to think about. Of course, the other sort of counterfactual to take on the male-female story is that this has been very different to previous recessions. And in previous recessions have mainly been about declines in manufacturing and construction employment, causing big decreases in employment for males. The traditional sort of recession, so this is the average of what happened in the 70s, 80s, and 90s, the orange or the brown and blue lines. Basically, after about 4 years, males had lost, their employment rate had declined 6 percentage points. Females basically no change sort of. So at least so far sort of it's very different. Of course, if this recession morphs into a more general recession where there are big effects on construction, you would expect that the gender composition of employment effects would start to look more like the traditional recession. Okay, this is the age story. So much bigger decreases in employment for young people. Like if you look at the employment population rate, about 10% for males, 4% 25 to 54, 1.5% for 55 plus. Mainly driven by the fact that young people make up such a large share of the workforce in accommodation, food services, retail, arts and recreation. And so then what you see as well, on the flip side, a bigger bounce back from May to June in young people's employment. So obviously not making up the gap, but fitting in with this idea that I've been pushing that, look, COVID is the big driver. Once COVID starts to recede, young people's employment picks up a bit. Now, one thing that I think it's important to say about young people is that a lot of people have looked at these numbers and said, oh, this is what we knew would happen. Young people's employment is being worst hit during the downturn. In fact, this is really just a first wave before I think we get to a second wave, which will be the traditional effect on young people. Young people are just unlucky that they happen to work in industries with a lot of personal contact. So yeah, it's not necessary. There's nothing necessary that young people, should have been worst affected in this first stage. It could have been old people if they were mainly working in these jobs, sort of. So the first wave, there's been a bad effect on young people, but that's mainly because they happen disproportionately to work in these industries, and that's going to get undone. But then, as we move into probably a more traditional recession, what usually happens? Well, usually a traditional recession, it takes a couple of years to get to the trough. During that time, you have two cohorts of young people leaving school and university, trying to get into the labour market in more difficult circumstances, and therefore experiencing lower employment population rates, needing to move down the job ladder to get into employment, and consequent scarring effects as well. So in a way, we haven't really got to that traditional sort of impact on young people yet. So this is a recession where there'll probably be two separate waves of effects on young people. This is a story which I think is about JobKeeper. So if you look at changes in the employment population rate by country of birth, if you're Australian born, if you're an immigrant who's been here 5 years plus, you had employment population rate fell by about 3 to 4 percentage points, bounced back by about 0.5 to 1 percentage point. But if you've been here less than 5 years, your employment population rate declined by 9 percentage points. And remember that JobKeeper basically excludes, most people who would be, at least, well, virtually all temporary immigrants who've been here for less, all temporary immigrants basically, most of whom would have been here for less than 5 years. So there, I think you can see the strong impact of policy. Okay, state. So this comes to, I think what Rod mentioned right at the start, that it's quite interesting, sort of like March to April, all the states kind of look the same. You know, a bit of, you know, all go down by a lot. But then after that, you start to get some quite different stories. So you can see Western Australia went down, you know, quite a bit, but then basically because of the success in controlling COVID and relaxing the restrictions, you know, it was actually increasing from April to May, when the only other state that was happening in was South Australia. All the other states were still going backwards. So, you know, strong increase in Western Australia. South Australia, of course, you know, similarly, you know, gets COVID under control, can start to increase. Whereas Victoria sort of, you know, takes longer to start relaxing the restrictions. So it goes down further and then sort of starts to come back. Tasmania, I think this is, you know, really because Tasmania relies so much on tourism and they kept their borders, they still have the borders shut, that they kind of went down so far before they start to increase again. So I think there's a story here of diversity from April to June, which fits in pretty closely again with COVID. Then we can kind of use the ATO ABS data to kind of look at the period from mid-June to mid-July. And there, as Rod suggested, you know, what you see is Victoria starts to be a real sort of anchor on or a dead weight on employment growth in Australia, sort of, you know, basically from mid-June, employment starting to, or the number of jobs, sorry, you know, starting to decrease and decreasing quite strongly through to July 11th. And you have to think that that's going to be, you know, we're going to be probably back to below, when the next data comes out, below where we were in mid-April. So yeah, so it's kind of, you've had this kind of increasing diversity in the story by state, sort of, that we all kind of look pretty much the same March to April, but as the course of COVID's diverged and as the policies have differed, you're starting to get very different sort of outcomes by state. And so when you look at the Australian data, as Rod pointed out, you know, there's a compositional story underlying that. The compositional story isn't there at the start, but as you go on, it is there. Okay, so the final part of the talk is JobKeeper. I should just see, yeah, how, so yeah, I guess getting close to the end, so I'll try and run through this reasonably quickly for you. I guess, yeah, we just felt like JobKeeper is such an important program, been a lot of discussion about it. We should say something about it. So I won't go through all this. We have a section in the paper where we talk about the objectives. You know, of course, that's underpinning household income, maintaining business viability, preserving job connections, eligibility, structure of payment, uptake. You know, 3.5 million workers supported by the middle of June, when the JobKeeper report was done. We've got a graph in there that kind of tells you about take up by industry. Sort of interesting. Most industries, the take up of JobKeeper is pretty much in line with the decrease in hours worked. The two big outliers are accommodation and food services, where the take up of JobKeeper doesn't really seem to be proportional to the share of hours lost, maybe because of the large proportion of short-term casual employment in accommodation and food services. And construction, which is a bit of an outlier, they seem to be getting more JobKeeper payments than you might think would be warranted based on their share of the decrease in hours worked. Okay, so then we have a section where we say, look, the things that people seem to be most interested in are employment, labour, income and benefit cost of the program. We have a bit of a conceptual framework where we say, look, it's useful to think in terms of three kind of profit maximising levels, hours of work for a worker. What would have been their profit maximising hours of work pre-COVID, their profit maximising hours of work post-COVID without JobKeeper, and their profit maximising hours of work post-COVID with JobKeeper. You know, so for example, without JobKeeper, maybe post-COVID hours of work are less than pre-COVID hours of work because the employer doesn't want you to work as much. But then maybe if JobKeeper, the subsidy, induces the employer to open their business again, then HJK is going to be greater than H post C, because the hours of work with JobKeeper are above the hours of work in the absence of JobKeeper. Okay, we just use that framework a bit in talking about the impact. So basically, in theory, JobKeeper can have two effects on employment: a work connection. So basically, the idea is the subsidy. Employers essentially have a 0 hourly wage for workers up to the number of hours that equals $750 divided by the usual wage. There's also this job connection, that you can have a worker on 0 hours but still be paying them in order to preserve the job connection. Labour income: whenever there's a worker whose post-COVID weekly earnings would have been less than $750, then basically they're getting an increase in their labour income up to that $750. That could be because COVID induces their employer to offer them more hours of work. So part of the gap between $750 and H hours post-COVID times W could be made up by the JobKeeper hours being greater than the post-COVID hours, or it could just be a pure income transfer to the worker, that they don't, JobKeeper doesn't affect their hours, but that they just get it as a pure income transfer. There's been a lot of discussion about this. Obviously that income transfer could partly be substituting for the fact that your hours of work decreased pre-COVID to post-COVID, or it could be that you're always earning less than $750, but you just got lucky that because COVID's this flat payment of $750. The other thing that's attracted a lot of attention is the incidence of JobKeeper. Basically, JobKeeper is a subsidy to employers equal to the weekly earnings that they would have been willing to pay a worker post-COVID in the absence of JobKeeper. So, if an employer is willing to, if in the absence of JobKeeper, if they'd hired someone for 10 hours at $30 an hour, and now JobKeeper comes along and they've got to pay their employee $750, well, essentially they're getting a subsidy of $300 because they would have been willing to pay $300 even if JobKeeper wasn't there. And so the income to the worker is equal to $750 minus the subsidy. Okay, so in the paper we try and say something first of all about the causal impact of JobKeeper on employment. So we do a couple of exercises. One is that we compare between casual workers who are eligible for JobKeeper and not, and we kind of note that, look, they were kind of, their employment paths were sort of on a similar path up until announcement of JobKeeper, and after that, bigger drop away in employment for short-term casuals and long-term casuals. In fact, about like 11 or 12 sort of percentage point difference a month after. You'll see the series converge. The reason that happens sort of is because when employers start hiring casuals again, by definition, they're short-term. So if you kind of want to know the policy effect of workers being on JobKeeper, it's probably best to focus on the first month versus not on JobKeeper. Best to focus on the first month. Now, this is some evidence sort of potential impact of JobKeeper. Of course, it could be that it's all the other stimulus payments that are inducing employers to maintain employment at this level or start to increase employment, and that what JobKeeper is doing is just directing them towards keeping longer term casuals rather than short term casuals, because that then means they can keep the JobKeeper payment. We've got some extra data sort of which we talk about in a footnote, but we hadn't got permission yet to use this, where we compare between sort of hospitality businesses with relatively high and low proportions of workers eligible for JobKeeper, which I think gets closer to causal evidence, and that because that shows that businesses which are higher proportion of workers eligible for JobKeeper experience much lower decreases in employment than those with a low proportion. The other interesting evidence I think we have is this cross-country evidence. So, basically New Zealand introduced their wage subsidy program, which is very similar to ours, about 2 weeks earlier. And you see New Zealand basically doesn't experience much decrease in employment as well. Australia does, but as soon as JobKeeper is announced, that sort of stops. Now you might say, well, that's because New Zealand didn't take such a hit to revenue. In fact, New Zealand took a much bigger hit to small business revenue than Australia. In New Zealand, small business revenue decreased by about 40% in the first month. Whereas in Australia, you can see it's decreased sort of much less than that. Yet New Zealand sort of has had smaller decreases in employment than Australia. So yeah, we're not claiming we've got really big causal evidence here or anything, but we do raise the possibility that the impact of wage subsidy schemes like New Zealand and Australia introduced may be prospective, that they work mainly by preventing future decreases in the number of jobs rather than undoing effects that have occurred in the past. That would be one story consistent with the timing of the introduction of what you see in New Zealand and Australia. Okay, what we know from the Treasury JobKeeper report is the equivalent of about 875,000 employed persons had an increase in their labour income. We also know from the JobKeeper report that about a third of that is via the JobKeeper payment being above usual earnings, about a third of it two-thirds of it making up for lost earnings. Yeah, you've got to take, this is it's assisted a lot of people to, maintain higher incomes, but obviously it's a very expensive program. And the JobKeeper report makes clear that 3/4 of it has gone to employers as a subsidy, that a quarter of it has gone to workers in terms of increased labour income, 3/4 of it is a subsidy to employers. And so I think, you've got to take seriously the question about benefit cost.
Jeff, if I could just interrupt, we've only got a few more moments. We're sort of running over time, so if you could just try and wrap things up.
Oh yeah, this is the last slide.
Oh, great. Okay.
So yeah, basically the point is that I think it's going to be really how you think about benefit is going to be critical for benefit cost of JobKeeper. If you define it very narrowly in terms of the short run impact on employment and labour income, it's an expensive program. Like Bob Brunig and Tim Watson have backed out $75,000 to $100,000 for a job, which is way above sort of any of the estimates for US job creation programs, for example. But if you include the benefits to longer run macro stability, for example, preserving employment connections, maintaining, if the subsidies contributed to maintaining the viability of businesses that can be profitable in the long run, but might have gone under because of COVID, then you probably go a lot further to thinking that there's a positive benefit cost from the program. And of course, it's important to judge benefit cost in the context of sort of, well, what other policies are available and the time the time constraints. So that's it.
Great. Well, thanks so much, Jeff. That was fascinating. I feel like we could sit here and listen to you talk all day. We've got a few moments for questions. So does anyone have any burning questions for Jeff? Alison, I think you're muted
Alison,
there.
you're muted.
Sorry. My question, Jeff, was what's next, given all the second waves, etc., and the cost of the package so far in terms of billions? Can they keep doing this if we're focusing on the long run benefits? Sorry, I appreciate your crystal ball grazing, but just your feeling.
I think it's definitely good that I was kind of an advocate of keeping JobKeeper because it was kind of a known program and I think generated sort of confidence effect. But I was also a big advocate of much more targeting sort of. So doing the revenue test against quarter rather than sort of a month, and being able to demonstrate that rather than kind of saying that we think we're going to have a month when the revenue's below. And starting to decrease the size of the payment. I think that was sensible sort of, because I think that, so I think it was sensible to continue that program, but I think as we go on, hopefully if we get out of COVID in Victoria and keep it under control other places, policy needs to become a lot more, targeted. For example, at the groups who we know are going to be most adversely affected, young people, long-term unemployed, thinking about making sure there's not longer-term effects on females. We need to sort of worry about the fact that we're likely to go into a period of accelerated structural change once JobKeeper's taken off, and for the type of reasons that Rod was talking about before, the kind of compositional change we're likely to see. So I think we need to think about programs to sort of smooth that that adjustment. And I think, yeah, we kind of got to bring on, the kind of longer term initiatives to improve productivity, like, improving the training, reform of training system and that. I think that's going to be important as well.
I ask one quick one. I'm wondering, since all of this, this is a recession driven by governments deliberately closing industries, right? So it's a very unusual kind of recession. And most of the statistics that emerge are about the consequences of these government-required closures of industries. But because the whole point of it all is to control the spread of this disease, I'm wondering whether or not the health effects are beginning to influence the labour market statistics a bit. Now, I recognise that most of the people who suffer the disease most seriously are older and therefore probably not in the age groups that would affect the labour market that much. On the other hand, though, there's a lot of quarantining going on. Right? Young people seem to be catching this disease at a high rate and indeed spreading it, and then are required to quarantine for 2 weeks and so forth. One imagines that eventually those numbers are going to start featuring in the labour market as well. That is, the people who are required to stay at home simply because of quarantining.
Yeah, my feeling is those numbers at the moment, those numbers at the moment are swamped by the effect of the disease on consumption spending. But yeah, right, of course, if this, if let's, touch wood not, but yeah, if it gets more out of control, sort of, and you need to have, well, yeah, I guess there's the when it gets so when you've got it, when it's out there, sort of, people are withdrawing from consumption. The government puts the restrictions on to one level. I guess if it gets worse, then as we've seen in Victoria, you go to a further level of restrictions, and that has the effect of reducing economic activity. The effect of people actually having the disease and sort of quarantining because of having the disease, I think that's still a relatively small part of the story at the moment in Australia, sort of. And I guess let's hope that it doesn't become sort of a big part of the story. I think the first order consequences of COVID getting worse, I think, are really to do with the government restrictions and the withdrawal effects at the moment, sort of.
No, I do think in the long run, I mean, there's all this evidence emerging now that those who catch this disease very frequently long-run health impairment.
Yep.
Anybody who watches Boris Johnson's performance closely is likely to conclude that there may be permanent effects. And so that could, in fact, influence the performance of the labour market in the very long run. But I agree with you, we're not seeing any of that yet.
Yeah. No, the other big effect in Australia is just the closure of international borders and that, which is basically preventing sort of, that, if you want to talk about something that could have a large, appreciable quantitative effect, that's it. That's the big thing probably that's going to affect absolute numbers in the labour market in the next couple of years.
Okay, I think in the interest of time, I might draw the meeting to a close. So thanks again, Jeff, for a fantastic talk. We hope that things improve over there in Melbourne, and take care, stay safe, and hope to see you in Perth at some point.
No, that'd be fantastic. I seen Michael McClure there, and I was looking forward to coming to the Conference of Economists, to having been in Perth, I guess, just last month, sort of. So. I'm very looking forward to being there next year.
Looking forward to having you.
To see you all. And so thanks for that, Michael. And thanks for the good wishes. Thanks for the invitation. And thanks for the discussion as well. Those were hugely useful sort of comments and feedback. So thanks a lot.
Right. Thanks once again, Jeff. Thanks everyone.